So anyway, just to go, so you start your hedge fund, and let me just take you to 1987. That was a big moment for you, the year of the great crash.
Well, the crash of '87.
Always, first and foremost, protecting your ass. And that's why most people lose money as individual investors or as traders, because
I had 2 phenomenal learning periods where I lost everything. Like I had $10,000 and went down to 0. And then I made back like $20,000 and then went down to 0. And I remember I had, by the time I graduated from college, I already had probably at least a master's in probabilistic theory. And so
Tell me, how did you become who you are?
Well, it's funny, I got to be a trader probably because when I was really, really young, I was a game fanatic. I played every single game that there was: Monopoly, Life, Parcheesi, poker. I used to play hours of solitaire. I just loved playing games. And so...
You're very competitive in solitaire?
Everything. Well, oh gosh, there's a lot of things I can say, but I won't. Thank God, I see the head of my investor relations here is going, be calm. Remember, there's a lot. This is a public venue. Don't be yourself.
Yes, whatever you do, don't be. That's what I get. Whenever I walk out, whatever you do, don't be yourself.
So anyway, I played a whole bunch of games. Chess, backgammon when I was older. When I was in college, I was the bookie in our fraternity. So I had, by the time I graduated from college, I already had probably at least a master's in probabilistic theory. And so when I was in college, I had no idea what I wanted to do other than drink beer, and that I was extraordinarily good at. So I think it was February of my senior year, the guy that I inherited the book from said to me, oh man, and his name was Bob Wilson of Wilson, Arkansas. Robert Ely Wilson V of Wilson, Arkansas. He said, you got to try this soybean futures. I'm back and we're hedging up. They had a huge plantation at the time in Arkansas. We're hedging up our soybean crop, and this just makes football gambling just pale in comparison. And then literally that weekend, I read a story on a guy named Richard Dennis, who was the biggest local at the Board of Trade, and then he used to say that he did his best trading when he was hungover because there was no emotion. And I thought, this is starting to get close to what I'm culturally pretty good at. And Sterling Brown said, the secret to happy life is not to have a career or a profession or to want to go do this, but to have a calling. And so for me, I think in everything that I've done, it has been a calling. It's drawn me, something's drawn me to it, rather than me thinking, gee, I've got to go there. And I think those are it's a really profound concept, that let life pull you in the direction that just comes naturally, and you're going to find that perfect intersection of purpose and happiness.
And so, now just, when you were cotton trading, were you a local?
So I started out...
On the floor or above?
I started out as...
Not that anybody knows what this means anymore.
Right. Well, that's actually a really interesting point, being a local back then.
These are the people who stood in the pits.
Yeah.
And, everybody saw the movie Trading Places, and they waved their arms, and they say
So that actually, if I think back, that might be the biggest miss that I had in my career was, and we'll get to that in a second, but I started out working as a broker, and back then it was great because 21 years old, they come in, you take the Series 7, it literally took 2 weeks to study and pass it, and then they hand you, back then they handed you, at least in the commodity division, E.F. Hutton, this gave me a book on technical analysis of stock trends by McGee and Edwards. Yep. He told me, read that. I read it. Go home, read it again. I read it. Go home, read it again. I read it. He goes, you're ready to trade. You're ready to open accounts. So I'd say within 4 weeks, I was trying to talk my parents' friends into opening accounts and let me trade. And at 21, it was literally hilarious. But that's how I started. And then ultimately, as I started trading these accounts, the guy that I worked for that originally hired me was the greatest cotton speculator in the world. His name was Eli Tulloh, so he'd sent me to New York City. I guess I was up here for 6 months working on the floor. Then I went back to New Orleans. That's another long story. Came back to New York. And during that period of time, I enjoyed so much the interaction with all my customers. I've always been, I think, a sociable person, so I enjoyed that so much that we were making money and talking to them all the time. But then after a while, I realized I could do so much better if I just traded for myself, because the commissions back then were, and this is going to make you really excited, were $90 a contract. Can you imagine that?
Yeah.
And what is it now?
You could trade $40,000 for $90 today.
Yes, exactly. So it was $90 a contract, and I realized I could go trade for myself and clear. I think even then, clearing was still 30 or 40 cents a contract, and just do. And I started doing that for myself, and I did really.
So you're successful.
Focusing on losing money. They need to focus on the money that they have at risk. How much capital is at risk in any single investment they have? If everyone spent 90% of their time on that, rather than 90% of their time on pie in the sky ideas about how much money they're going to make, then they'd be incredibly successful investors.
So you were successful from the start?
Pretty much. You know, I had 2 phenomenal learning periods where I lost everything. Like I had $10,000 and went down to zero. And then I made back like $20,000 and then went down to zero. And I remember...
Are you just using these low numbers so we can understand?
No. This is when you're 22 years of age and it's 1978 or 9. That's just, you know, a gargantuan amount of money. And I remember my father coming to me on the 3rd time and said, "You've got to get in something safe like real estate."
Exactly. Lending.
I said, no, I'm going to stick with this. And the rest is history. But I guess the point was, it was so funny. I guess by 1980, I was doing pretty well. And in 1980, I thought, my father kept going, "You've got to do something respectable." So I applied to Harvard Business School and got in. And I was thinking, okay, I'm going to go up there, and what is this place going to teach me? I was already I was probably making a couple of $1 million a year trading my own account, which was a fortune back then. And the weekend before I was supposed to go, I was loading up the U-Haul to drive to Boston and just said, this is crazy. They're not going to teach me anything about this, and this may disappear. And so I never went and continued trading. But I started my hedge fund. You get back to the point, the one thing about trading for yourself, I got so lonely. I really did. I was doing real well, but I was so lonely. And back then, the cotton exchange closed at 3. I'd go home I'd do all my charts and stuff, go home at 4:30, watch Star Trek, and that was kind of my life. It was not, it was financially fulfilling, but it was unfulfilling in every other way. So
what about the intellectual satisfaction of talking to the other locals?
Yeah, right. That was why that ended up being the greatest mass extinction in my lifetime. That would be my one biggest. If I had one regret, it was there were probably 100,000 people like me. If you think about the '80s, that were floor traders.
The ecosystem was big.
It was enormous, and it probably supported, I would say, something in the neighborhood of $5 to $10 billion in profits, not evenly distributed, certainly not evenly distributed, but distributed over that ecosystem. And then along came electronic trading, and it was really interesting because there literally was a mass extinction of entire profession, and it happened so slowly and incrementally that no one ever saw it. And it was really kind of the precursor of what's happening today, in the sense that we took all those profits, which were being distributed in an egalitarian fashion, or certainly some kind of distributed fashion, and then we compressed them. And I would say there's probably 3 or 4 firms, 2 or 3, Renaissance would have been one of them, and D.E. Shaw. Those companies really took that entire profit structure, or that profit ecosystem, and then...
Or the inefficiency that they were getting paid for, which was just a kind of an inefficiency and a burden on the market, just went into a different place.
It only shifted. I wouldn't call it inefficiency. It's just a transactional nature of being a liquidity provider. It went from being distributed among 100,000 people to being distributed, say, among 1,000 people. And that was the power of the computer, right? And so we're obviously facing that daily today as the economy changes and morphs. And you're seeing that right now with this massive income stratification too, right? As the people who have the quant skills are able to do at scale what it used to took, tens, hundreds, thousands of humans to do.
Paul is on the phone to an oil trader who's saying somebody's been selling a lot of oil, but he doesn't know who.
That was my buddy at probably, again, the second or third largest crude trading firm. And his guys went, man, these guys, they sold the hell out of it. And the people that he worked with don't know that it was, which is great. That's even better. I hope they think it's some wild as shit Arab who knows the whole agreement's getting ready to fall apart.
So anyway, just to go, so you start your hedge fund, and let me just take you to 1987. That was a big moment for you, the year of the great crash.
Well, the crash of '87 was really interesting, just because the crash of '87 probably never would have happened except for, again, the market infrastructure at that point in time. I remember, because I started out in '76 trading commodities, and so for 120 years, all commodity futures had limits. And I remember so many times in the late '70s, early '80s, where the cotton market would be limit up, or the soybean market would be limit up, because that was the allowable amount that prices could move. And they would not let them go anymore because they knew the irrationality of human nature and the possibility of what a mob can do to anything. So they had limits. Now, financial futures come along. Here's a funny story. Do you know I tried to work for Goldman in 1984? When y'all were first thinking about futures, and they went, that's not futures. No, we're not.
Listen, I couldn't get a job.
We're not going to do that because we're Goldman. We're not going to be in that business.
I didn't get a job at Goldman. I only got a job at J. Aron.
Okay.
And J. Aron was bought by Goldman.
That's right.
Yeah.
Right, that's right.
So
anyway.
What is it with these Goldman guys?
They have
Stuck up.
Incredibly inflated themselves. But anyway, so '87, there were no limits. There were no limits on any financial futures. It was just an absolute accident waiting to happen. And then they started portfolio insurance. And in '87, you could just look on any kind of historical metric and see the stock market was stupidly overvalued. 10-year rates were 10.5%. And I think the dividend yield on the stock market was about 4.5 or 5. So just think about that compared to today, right? 500 basis point, we'd have 10-year rates right now at something like 7.25, 7.5.
Well, the forward price of the stock would have been a hell of a lot lower.
Exactly. But they weren't then. And so when the market finally broke, I mean, the one thing that I would say I've learned the past 40 years is these, price patterns and price stories. It's the same old story so often, just with different characters, different times, different plots. And so that looked a lot like 1929 to me. And I knew for a fact that if and when it broke, because of the derivative structure, that the downside was going to be unlimited, literally unlimited, because there were no limits on futures. And I would kind of liken it to this past February's market break. We had that kind of what was that? Was it a 7 or 8% in 1 week? And you had all the VIX ETNs, you had all the short VIX structures. Those were that was just a bomb ready to explode. That was just a matter of time. And that entire break in the first week of February was all derivative inspired. And if I think of some of the greatest financial crises of the last 30 years, they, generally speaking, are derivative inspired because that's where all the leverage is.
Leverage, right.
Yeah.